Joining me now, Brian Belski, CEO and Chief Investment Officer at Humilis Investment Strategies. Brian, first time on, great to have you.
Wow, this is so exciting. I got a lot of letters after my name, I don't know.
We're excited to have you on. Let's kick things off with your price target, because I was taking a look, S&P 7,500 to 8,000 this year, and S&P 500 is actually at 7,566. So is this it? Or are you going to boost it from here?
No, I mean, we've been publishing price targets on the S&P 500, I think, as the person at the top of the piece of paper since 1998, believe it or not. And we typically like to underpromise and overdeliver. I think in my career since doing that, I've had to downgrade the market twice in terms of being wrong and being too bullish. But at the end of the day, we think this is going to be a pretty broad range between now and the end of the year, because we do think we're going to get some sort of a correction. Correction will be positive. In earnings-driven markets, markets are usually more volatile, and we've had some of that volatility, but the more people right now that are talking about a correction, more means that we're not going to have one. So what I love it that more people are getting more and more bullish on earnings. So the less amount of people that are talking about corrections, the more likely they're going to have one. It happens when you least expect it.
And you're saying that a correction would be positive because you would be looking at it as a buying opportunity.
Correct. Because we've had this really weird market this year where everything's been very binary and very, very focused. All of a sudden, we like the memory stocks. Everyone's buying the memory stocks, and they kind of forget about everything else in tech. So I think there's going to be an opportunity. The market's already showing you that we're broadening out across all sectors and industries and asset classes, which was our call at the beginning of the year, that we're going to have a broadening out of the market. So we're glad that we're right there, at least. But at the end of the day, we think that's very fundamentally positive about the U.S. stock market.
So let's talk about what looks attractive right now, even if we don't see a correction. Where would you be comfortable putting money to work today?
We love the financials. We're overweight financials. We're overweight communication services. We think tech, being well over 30% of the market, you have to be much more selective. We're neutral there. We're underweight the Meg-7, but we have overweight positions in names like Apple, Microsoft, Nvidia, and Google, of course. But Google is not a tech stock, by the way. It's a communication services stock. So
wait, stop there for a second. Underweight Meg-7, but overweight all of those names. So you essentially just don't like Tesla and...
Well, I can't tell you all my secrets, but we don't own Meta.
Okay.
We don't own Meta. We haven't owned it for a long time, so that's a big part of the Meg-7 that makes us, in totality, underweight the Meg-7. You follow me?
Okay.
So remember, too, that in the Meg-7, you've got Tesla, which is a consumer discretionary stock. You've got Amazon, which is a consumer discretionary stock. And you've got Google, which is a communication services stock. By the way, communication services has just been rocked this year so far because of weakness in Netflix, which we think is way overdone, weakness in AT&T, which we think is exceedingly overdone, and Spotify, which is not in the index, but a lot of people put it in the communication services space. So we think a place that people aren't thinking about right now for the second half of the year is communication services as a sector. We think that that's going to rocket back, led by Google, a recovery in Netflix, and I think people coming back to Spotify.
So a recovery in Netflix. What else do you like in that space? If someone says, okay, communication services, that's under the radar, how do I add exposure?
Well, we like Nexstar Media, which is they own a bunch of television stations, primarily in Texas. We like the new Paramount company, especially with the integration of Warner Brothers. Now, we think that company, really the theme for communication services is content, and we think the race for content is on. We're going to see more consolidation, I think, in communication services. The thing about Netflix is it's been in the penalty box, first because they were going after Warner Brothers, secondly because they didn't get Warner Brothers. And if you take a look at that company, I think more of the move to live events and more of the move to sports is really going to be very beneficial for that. Lastly, you've seen Comcast is another stock that has been absolutely crushed, but now they're breaking apart their entities. And I think Comcast is a company getting back to their core competencies of broadband, and on the business side of things will be very positive, much to the same tune as AT&T's done. So I think a lot of the money actually has come out of communication services and chased more of the areas within tech. So I think what the market's doing is kind of rotating into some of the areas that have been underperforming.
I was taking a look at your mid-year outlook, and you said today's valuations aren't actually as stretched as many believe.
Yep.
What are investors missing that think that this looks expensive?
It looks expensive because they see the price performance of the market. You can't just look at price. you have to look at what's underneath that from a valuation perspective. So you have a P and an E, right? In terms of valuation. The E side of the valuation continues to grow. The market right now is cheaper than it was a year ago, and look how much the market's up over 20%. So that means earnings are growing faster than the market. That's very, very positive. That's kind of number one. Number two, we become very binary in our investing. I'm going to buy Micron and SanDisk because it's going up and everyone's really excited about it. But guess what? The stock market is a market of stocks, and the more diversified we think in a market like this that is broadening, you're going to be way ahead of the curve in terms of small mid-cap stocks, value stocks, dividend growth stocks, not just the ones that are on the headlines every day.
So as you think about your picks with a value lens, what are the best values out there right now?
Financials.
But names.
I would
because
say,
you say financials and JP Morgan, Goldman Sachs are near all-time highs.
I would say within the, okay,
but
that's a
the
trap.
P and the
That's
E,
a
yes.
trap. Just because a stock is up doesn't mean it's great value. Like, Jamie Dimon's the godfather. He's the godfather of the financial industry in this country. That's the gold standard. But I think from a valuation perspective, you take a look at Wells. Now, we own Wells and Citigroup. Jane Fraser came in 2021, had a hard time implementing her plan. Nobody believed her. We doubled our position in 2023 in our value portfolio because we thought this is the stock that's going to execute. They're brought in fantastic leadership in the management side, and that they executed. Look at the earnings were fantastic, okay? We think Wells Fargo is going to be the next one. They've kind of bumped along the road since Sharf came along, but about a year and a half ago, they started executing their plan. The stock is trading 2 to 3 multiple points lower than Citigroup. So we think from a value perspective, Wells makes sense. I think the private equity companies are a little bit more of a value trap right now. We wouldn't be diving into Blackstone or Apollo yet. We've owned Blackstone traditionally. We think we're getting closer to that, but not. Insurance companies like Travelers, Unum look very, very interesting from a value perspective. And then small cap financials, companies like Glacier Bancorp in Montana, FNB Bancorp in Pittsburgh. They have great relationships with their clients, great cash flow, and a great book value.
What are you avoiding right now?
We're avoiding parts of consumer staples. We think they're very expensive. I think a lot of people in the beginning of the year when they got worried about what was happening in the Middle East, were swayed toward the more traditional areas of the market which are so-called defensive. So like the Pepsis of the world, the General Mills, the Kellogg's, these stocks are expensive and they're not growing. And oh, by the way, habits are changing in terms of how we're eating and what we're buying. I think that's one of the bigger issues. Energy looks great kind of longer term, but if you think about energy as a commodity, it's probably the most volatile of the commodities. And just because energy prices have gone up doesn't mean inflation is going to go up because, oh, by the way, when energy, if you look at the price of WTI, it's very volatile. It will reverse and go lower. And we are, the United States of America, is the largest producer of oil in the world. We forget about that. And so I think production is going to continue to go up. And once we kind of move past this malaise in the Middle East, I think that will start to see oil prices lower. And oh, by the way, I think that's why the market's just kind of poo-pooing what's happening over there.
Yeah, I mean, S&P 500 sitting very close to all-time highs, despite the fact that we haven't seen any sort of resolution there, and oil is sitting near 80. So at what point does the market have that wrong?
I think it has it wrong if we see some sort of very protracted positioning there, you have boots on the ground, or something, God forbid, would happen to American forces that we don't see coming. Some sort of a surprise, and again, God forbid that would happen. I think that could shock places, shock the market. But again, shocks in the market like this are buying opportunities, and that's why you have to be diversified and not just be in the high flyers, because, oh, by the way, the stocks that are up the most are going to be hurt the most.
We are getting some dips in the market, though, even on up days. And we're seeing the memory stocks, for example, which had been huge high flyers, off double digits this week. Are you finding value in those?
No, we don't buy stocks because they're valuable. We buy stocks because they're fundamentally working. And the way our approach to the way that we run our 8 separately managed account portfolios, 5 of which are U.S., is that you can't own everything. So we run a 46 stock U.S. focused opportunities portfolio. We don't own any Micron. And the reason is because you can't own every semiconductor stock. You have to be properly diversified across the tech space and across other areas that we think are more consistently growing, including communication services, including financials. So you can't own every tech stock. So that's why we've made our bets with Microsoft and Oracle and Palantir and Palo Alto And on the semiconductor side, NVIDIA, Broadcom, AMD, and a little bit of Qualcomm. Those are our stalwarts. You can't own everything.
But some might say, if you owned Micron, you would have been doing much better than owning Oracle, Palantir.
Sure, for 1 quarter.
Microsoft.
For 1 quarter.
Okay.
We don't invest money for 1 quarter.
So
and
you
God
think
bless
that
them. It's fantastic. I think, again, you can't just say that's shoulda, coulda, woulda investing.
Sure.
Good luck with that. I mean, at the end of the day, you have to be a longer term investor with a process and a discipline. And I think it's amazing. Yeah, it would have been great to own Micron.
Yeah.
Way to go. Congratulations. But we missed it. And with much humility, we missed it. But at the end of the day, we can't own everything.
Yeah.
So we're going to remain convicted in the names that we own.
If someone owns nothing but index funds right now, what's the first area that you'd add around the edges?
I think S&P 500 type product. I would certainly be looking at small mid cap because I don't think small mid cap, I know small mid cap is not owned very well, much across the market cap spectrum. You know that the entire small mid cap publicly traded market cap spectrum in the United States of America, if you take the SML, which is the small cap 600, and the S&P 400 mid cap MID, you add them together, you know that the market cap is smaller than the total market cap of Apple. Think about that. So if you talk to investors about that, you got to be a stock picker. That really excites me that you can find individual names there. And people say, just buy Apple. Well, that's not, part about being investing is, again, the market is a market of stocks. And you want to be involved in stories and own names for the longer term. And so that's what really excites me about small mid cap.
Okay, more upside than large caps?
I think so. I think small mid caps are going to outperform, principally because of earnings. Earnings growth and cash flow are a lot stronger in small mid cap than they are the large cap stocks.
Okay, I think this is a great time to pivot to our rapid fire game of this or that. This is your first time playing, so we have quick questions, quick answers, no hedging.
Right.
Are you ready?
No hedging.
More likely, S&P 7,500 or 8,000?
8,000.
Aggressive dip buying or strategic wait and see?
Wait and see.
Wait and see what?
Wait and see, wait for the dip. You never want it, you're never going to pick the bottom, so wait till it begins to turn.
Equal weight or market cap weight?
Equal weight.
More upside in second half, financials or industrials?
Financials.
Tech or financials?
Financials.
Big banks or regionals?
Regionals.
Growth or value?
Value.
Small caps or large caps?
Small caps.
Small caps or mid caps?
Small caps.
Meg-7 or the rest of the market?
The rest of the market.
One Meg-7 you would buy here.
Google.
One you'd avoid.
Meta.
Semis or software?
Software.
Best software pick right now
Microsoft.
that's not Microsoft.
Palantir.
Team Elon Musk or Sam Altman?
Musk all the way. All the way.
SpaceX or SK Hynix?
SpaceX.
SpaceX here, or are you waiting for lower?
I'm waiting. I have a rule, 6 months, 2 quarters of publicly traded, then I'll look at it.
2 quarters of publicly traded, but not profitability.
Correct.
All right, one word to describe how you're feeling about the market for the rest of this year.
Positive.
That is Brian Belski, CEO and Chief Investment Officer at Humilis Investment Services. Thanks so much,
Strategies.
Brian Belski, CEO and Chief Investment Officer at Humilis Investment Strategies. Thank you so much.
Thank you.
If you enjoyed this interview, check out our Street Talk with Kevin Mon. He gives over a dozen names that he'd buy right now.